From the morning reading, the SPX pulls back following travel ban. AMG jumps on earnings. Bull flags flying. Breadth weakened compared to the prior session as decliners led 2,098 to 903 on the New York Stock Exchange and led 2,112 to 611 on the NASDAQ. On the S&P 500 snapshot, a Monday sell-off, the worst close of 2017. Markets around the globe were in selling mode, triggered by President Trump's immigration ban, especially in Europe, where the stock 600 lost 1.05% by the close. The S&P 500 plunged at the open and hit its negative 1.04% intraday low shortly before 11 a.m. It then zigzagged slightly higher until the final 30 minutes when the closing algorithms trimmed the loss to a 0.60%. The Dow dropped below its celebrated 20,000K benchmark and posted a closely matching 0.61% decline. Stocks formed denial and gap. After jumping at the open last week and trading to an all-time high, the S&P 500 meandered, then gapped down and closed negatively on Monday, forming an island and suggesting a change in pressure from buyers to sellers. Futures returns after similar patterns were modestly negative. Small caps are bearing the brunt of the selling. The small cap Russell 2000 index has been lagging lately and saw the worst of the selling pressure among the major indices on Monday. That caused it to close below its 50-day average for the first time since the election. Similar losses of momentum led to negative returns going forward. S&P traders are betting on a decline. Put option volume in the S&P 500 options have been light relative to call volume, to the point that it is similar to the last two bear market lows in 2003 and 2009. But when we factor in open interest, it looks like the traders are more determined to bet on a decline than a rally. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:03 a.m. Mountain Time, and I am recording this in preparation for the market day of January the 31st, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, we had a bit of weakness, but nothing serious. The S&P futures were down about 0.25%. The Russell futures were down just below scratch. NASDAQ futures were down about 0.25%, as are the Dow futures. Crude oil was up just above scratch. Euro's up about 0.5%. Long bonds are up just above scratch, and gold is up almost 1%. In overseas action, we got a couple Asian markets that are still closed, China and Hong Kong. These are numbers that are reflected from the 26th and 27th. Japan, though, is open, and it's down about 1.7%. In Europe, they are open, and Germany is at scratch, and the United Kingdom is up about 0.5%. In terms of macroeconomic reports for today, for the United States of note, we have a long list of reports today. Employment Cost Index, Chicago PMI, Consumer Confidence, and that looks to be about it. We had so many reports for Tuesday, I didn't have room to put Wednesdays on there, so we'll have to skip that this time. In terms of current volatility conditions, short-term VIX 11.66, so still exceptionally low, but not as low as we have seen. Skew also up into the warning categories. We're up over 130. We're in at 134, almost 135 here. And so that's a fairly serious skew. IV percentiles also up off their lows and a pretty good little pop, but still you see the red. We're still very, very low in the context over the overall last 52 weeks. with the IV percentile and the S&P at a 14, the Russell 14, the NASDAQ an 11, and the Dow at 20. We did have -1 standard deviation size moves on all 4 of the U.S. broad-based indices yesterday on a close-to-close basis. That was preceded by 2 days of relatively quiet, followed by, and preceded then by 2 days of serious bullish action across all the indices. So, kind of what you see with an island top. In fact, let's go ahead and go to those charts, see what that morning author was talking about. So what you get, and this is using the S&P futures, we'll look at the other charts here in just a second, but you get, you know, a bullish candle followed by a gap up and relatively indecision type candle. Here you've got a spinning top or doji kind of candle, followed by a gap down and negativity, and certainly that was further reinforced with yesterday's action. Let's go ahead and go to the Spider ETF, and you can see this kind of activity. Frankly, I don't really see the gap that they're talking about. Let's look at the SPX. You know, clearly this is a reversal combination. As to whether this is an island top, frankly, if you ask me, I generally look for a true gap. So you kind of have an exhaustion pattern is what you're looking for, where you you gap from the close up. Now this is not likely to happen on the future, so let's probably look at the SPX for the best example of this. But I would expect that there would be a gap up, and then in this kind of spinning top or doji, and then a gap down. I suppose maybe this is what they're looking at. They're looking at, instead of a 3 candlestick pattern, it's a 5 candlestick pattern, where here's the gap up, and then the reversal pattern, and then the gap down. So I guess that could be called an island top. Certainly not a typical one that you'd see in the textbook, but it certainly has the same context. Certainly the 5 candle pattern or the 3 candle pattern is clearly a fairly typical reversal pattern to mark a at least short-term top being put into the market. Now whether that then follows through and turns into a bull flag and then more bullish continuation, that could very easily happen. But at the least, at the short term, those patterns generally have a fairly high probability of marking a top. Now, so far today, we've had confirmation and follow through on the island pattern with more negativity. Now, we'll see what happens when all market participants come in. Now, this has been attributed to the immigration ban and some of the perhaps unintended consequences of the immigration ban, perhaps also to just the general level of protests and stuff like that that might be causing some anxiety in the markets. Whatever it is, also put it in context that we were very extended, and really almost any excuse for a retracement, you know, can trigger activity when you're this far extended. We are right up at the top of the channel here, which we're kind of drawing on an odd channel here. It's more of a wedge looking pattern, very long-term wedge pattern. But we'll see where that goes later today. But certainly short-term reversal pattern seems to be in order. Same thing on the Dow. And best seen, I think, if we think of this as a multiple candle reversal pattern. And then the NASDAQ, more of a doji and its indecision, and then you had a higher close, and then falling back from there. So, and then the Russell, of course, the Russell, and I think one of the morning authors mentioned this, it's been the weaker, and you notice it's down in the cloud now. That marks that its overall posture is neutral, so it has lost the bullish market posture that it had coming into this pattern. But you see, this pattern has now lasted, since, middle of December, maybe even back into the middle of November. So after the big surge post-election, went into a sideways pattern and has now been there about 2 months. So this has been a very long-term pattern going sideways in a market that had been so bullish, leading the overall market up out of the post-election rally. And it has now deteriorated because of that prolonged sideways pattern into a neutral posture. So very interesting there. Now, expectations here, given the neutral, is that we would just continue to chatter between the relative highs and the relative lows until proven otherwise. In other markets, crude oil also in a sideways pattern. Bonds, of course, is put in, this big counter trend move, came up, hit resistance multiple times, and now has a lower swing low, a lower swing high, a lower swing low again, and would seem to be setting up for another lower high. So short-term trend, after a fairly significant counter trend move here, has seemingly resumed for bonds to the bearish side. The most important thing, of course, will be what happens when it gets down here to the 147.04 area, and does that prove to be a support pattern, which could end up giving us a kind of a W pattern. We might undercut that slightly. If we're going to find support here and have a change of trend, the most likely area is that we'd get this either double bottom or a W pattern with a slight undercut of this side and kind of a pullback to end of trend, and then a reversal coming into that trend. So this is there's some question here as to where bonds might go. You might have very little left to the downside here before a reversal pattern sets in. That's a lower probability. The larger probability is that this overall pattern just continues, and this was just something of a complex counter trend move, consolidation, and when it's all said and done, if you looked at weekly candles, it just looked like a bear flag and a continuation pattern to the downside. In fact, we'll go ahead and do that. Let's look at the weekly candles. And you see on the weekly candles, it doesn't look so complex, and sometimes that's what is very helpful, is that if you think a pattern is a bit fuzzy, just go to the weekly or the next time frame up, and then it'll start to clarify. And right now, this looks like nothing more than just a classic bear flag pattern, and the expectations is that it would not just break this, but continue down into the 139 handle. Okay, let's take a look at the dollar. Dollar's had so much to do with what's happening in crude oil, gold, bonds lately, and you see it's kind of gone into this sideways slop itself. It's also in its cloud, now neutral in its posture. So that's one of the reasons why we're seeing so much sideways consolidation in so many of these other markets. Let's take a look at volatility, and volatility, of course, set a new 52-week low at a 10.3 just a couple sessions ago, and then had the pop with yesterday's action. And at one time in the day, it was up, approaching a 13, so a pretty significant change. You think of that as going from 10 to 13, a 25 to 30% increase in volatility, but note that it fell way back from that. And indeed, one of the things to keep in mind with yesterday's candle is that we started out really quite negative, and that was relatively early in the day, and then the bulls took over, and we had a kind of gradual, slow increase all day into the close. And as they were to say, if the game had continued another inning or two, you might even have seen the bulls win the day. So this is bearish in that, yes, it's a continuation of this negativity, and certainly it's followed through with that. but the bulls did come in, and we'll have to see what happens as you get down here into these key levels of support. There was a key moving average line there where that reversal took place yesterday. And do the bulls maintain and hold this area? And that's all the bears can get out of it before we make, the next new high, and on we go. So right now it feels quite bearish, and certainly as we get into the daily report, we're going to see a number of indicators that turn at least short-term bearish. But let's not make more of this than there is at this point. Frankly, this could be nothing more than a just normal bull market noise with the normal inhale and exhale at this point. So the first thing that we've seen in a change, and we look for change here, and we look for rate of change, and we're starting to see both occur in the daily report. We look at the market from a number of different perspectives, and one of the things that we do is we look at the intermediate term phase opinion, and we currently are in market phase 5, which is the abbreviated description is the end short term, because you had a break of diagonal support. Now, on the S&P 500 charts, we have not yet had a break of horizontal support. So this is, perhaps the beginning of a process. At the same time, we'll note that the last time we had market phase 5 was not that long ago, and it then caught itself and went back to a 4 or even a 3. So there's been some oscillating going on as we've been in this sideways consolidating market. In terms of the market timing opinions, not much in the way of change here so far. We have 3 mechanical-based market timing signals that we follow here. The first one coming from IVD, Investors Business Daily, and that one's still in confirmed uptrend, so that's bullish. The second one, the GMI index, has deteriorated some. It's now 4 out of 6. And the GMI2, the more sensitive indicator, is now a 6 out of 8. And that's in a buy signal since 11:10. So that one retains its bullish posture, though a bit weaker than it was. In terms of the third signal coming from Stock Choice Decision Point Scoreboard, there's been no changes. Before this island top reversal pattern came in, had the exact same set of signals, mixed signals on the short terms, mixed signals on the long term, and we've been expecting that we would get slight bullish bias with incremental new highs and relatively shallow lows, and a pattern that would be, in alignment with these kinds of signals. And thus far, that's all we've gotten. So whether this weakness develops into something more and we start to see a cascade or waterfall into something with more energy and momentum is yet to be seen. So I'm kind of walking that fence between certainly alerting you that things are starting to deteriorate, and yet at the same time note that within the context of these kinds of signals, this may be more of a buying opportunity than something to be fearful about. Will have yet to be seen, and we're certainly going to look for the signs and symptoms to try to distinguish between the two. Between the two position sizing opinions, they're both at 100%. Intermediate term market posture, even with this island top reversal and this short-term weakness, we're still in an exceptionally strong bull intermediate term market posture that further is supported by an exceptionally strong bullish sentiment line. This is the longer term indicator, and it tells us that within the context of this exceptionally strong bull, not to expect there to be significant downturns or corrections, but that in fact downturns should be relatively mild and short in persistence and duration. So kind of keep that in mind. That's part of what we're reading into the tea leaves, as it were, from the various indicators. Also note that, all these are still in bull stance, and the Dow and the NASDAQ, exceptionally strong bull. Even the Russell, which has been clearly the weakest, is still in an intermediate term strong bull stance. Overall hedge warning status 0+, normal with some elevated conditions. We had been with the VIX and our strategy opinions for the option income strategy below the acceptable range. Now, we did have a bit of a pop yesterday that brought it back up into the acceptable range of being above a 12. In terms of the close of the VIX, we're at a 12.24, so we're just above that minimum acceptable range to initiate new positions for novice traders. We've been oscillating back and forth between that, so we're kind of leave a little bit of an asterisk here and see if we actually see an increasing VIX phase, or if this is just something that pops up above 12 for a day or two and then back below 12 once again. In terms of cover calls and put selling, this may very well be opportunities with this pullback to initiate some new positions, but still within the context that we've been talking about in recent sessions, you're still very high and very extended in some of these patterns. So be very careful with your individual chart, relatively conservative with your in the money versus out of the money ratio, and how you construct your cover call. But in general, these are presenting opportunities to do some put selling. I sold several put spreads for core put portfolio positions yesterday in the trading room. So there certainly are some buying opportunities. Now, while I said I did that, let's be real. The positions that I put on were all in companies that are very, very sound companies. There was nothing terribly aggressive about them. Our Falcon watch list for these new core put portfolio positions are made up of very, very stable, large cap type companies. So when we're selling puts in those positions, these are not the types of companies that are, in quotes, going to go out of business or suffer massive losses every time the market shows a little bit of weakness. So these were relatively conservative positions to start putting on some core puts. And we'll start to watch and see how this further develops as to whether we should accelerate that process or remain relatively careful. Now, in terms of the specific areas of warning, you see a lot more red here. We talk about that change and rate of change, and we had in the past sessions a number of warnings mostly related to low volatility conditions and an expansion of volatility expansion. At the same time, we're starting to see here not just perhaps a short-term at least pop in volatility, but there's a number of other related warnings as well. So this is starting to get a little bit of attention, and yet within the context of what we were talking about up above, when you get these kinds of pops and you see things like market and decline and sharp increase warning, well, that's very different when you have an intermediate term market posture that's a 40 as opposed to an 88.7 within the context of a confirmed uptrend in a GMI index with a buy signal, compared to one that is, a market in distress. So let's keep that in context. Trend-based areas, well, this one here has turned to 5. I should change that. But we're still with the intermediate term market posture of an exceptionally strong bull. On the New York Stock Exchange new highs, new lows indicator for the 1 month, you had 431 yesterday. So a couple weakness areas here in the trend-based area as well. Now, the intermarket risk aversion indicators, we had finally seen, most of those turn to risk on, and there still remain with 4 of those nominally in risk on. If we see more weakness a day or two, those will flip over and turn risk off, because the angle and separation was very, very slight, and we could very easily see these roll back over. So when you add all this together, there's a lot of warnings coming to us from volatility. There's some important warnings coming from the trend. There's warnings coming from potentially the risk aversion indicators. And, all that would seem to say that, there's something here may be developing. Now, the reason we keep very, very careful about this is that the overall exceptional, strong bull market posture tells us to. From a sentiment standpoint, we're actually neutral. So nothing excessive in terms of sentiment indicators coming to us at this point. Overall, yesterday, the sectors were very negative breath. The ones that held up the best were the defensives, and they just barely held on to positive. Consumer staples, utilities, just barely positive. Others, such as real estate, telecom, certainly lost less than some of the more high beta, risk on. Those were the ones that lost the most yesterday and had the most negative breath. Overall, sector specific, you see consumer staples, healthcare continue to be the weakest. Retail very weak, and this is probably related to the potential concerns around import, export, and are the rules going to be changing as a result of moves by the current administration. So healthcare, nobody loves healthcare, and retail is being impacted by these rules. So those two sectors are likely to continue to be quite negative. So if you're going to do some bearish trades, those would probably be the two sectors to kind of head for and look for consistent negativity. If you're going to do bullish trades, then some of the other sectors are certainly stronger than some in terms of their holding up. Consumer staples, utilities, the more defensive oriented, are not getting much ground either up or down. So, they're not a very directional place to be at this point. And you look at this, we've been following this kind of 1 month because we've been in this sideways pattern for the most part. And while we've had some more separation in recent sessions, we're starting to see, some sectors up 3-4% and some sectors down 3 and 4%. We're starting to see some separation in those consolidation patterns by sector. Okay, we've been quite a bit of time today. Some interesting things happening of late. Let's go ahead and wrap this thing up. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom of the slide for the full disclosure. We'll see you back here for tomorrow with the market preview from Falcon Global. In the meantime, manage that risk profile, and each and every trading session, go out there and try to learn something about your craft.